Hello and welcome to this video brought to you by Passing Score, where you can get more help on your finance exams at passingscorefinance.com. In this video, we'll be covering total return swaps, which are very flexible and useful in a lot of areas. So what is a total rate of return swap, or TRS, or total return swap, which is how we'll be referring to it here? Well, it is a credit derivative, but it's not the same as a credit default swap. It actually includes much more in the bundle of value that's exchanged in the swap, including interest payments, dividend payments, any fees earned by the underlying asset, as well as any capital gains and losses and the value of a credit default. In fact, just about everything's exchanged except for the actual ownership of the underlying asset and any voting or servicing rights. So, what kind of underlying are we talking about? Well, as this list implies, just about anything can be included as one leg of the total return swap, including equities, fixed income, real estate, stock indexes, and usefully, bundles of equities or fixed income securities can be one side of the swap. Any of these can be exchanged for the price of a fixed spread over LIBOR with payments made periodically. Let's take a look at a quick example. We have a hedge fund that wants exposure to a specific stock index for, let's say, $1 billion. Now, the hedge fund doesn't want to lay out an actual $1 billion in capital, so instead it enters into a total return swap. And for the payment of LIBOR plus 250 periodically, it gets the stock dividends and exposure to the capital gains and losses that it wants. It avoids having to replicate this exposure within its portfolio and going through all that trouble. It doesn't have to reinvest dividends that come off of those investments. And when the stock index changes, it doesn't have to rebalance the portfolio to keep the exposure the same as the actual stock index. All of this is handled for the hedge fund by the total return swap. Let's take a look at some other uses of a total return swap. Now we saw how we created leverage. A swap at initiation has a zero value for both sides and there's no exchange of principal. So it doesn't have to borrow or actually put out the money for this exposure. And this is very similar to a sale. So we've created a lot of the aspects of buying or selling an asset without having to actually do so. And we have exposure to an economic value for a certain amount of time, at which time we hand it back, which is similar to a repurchase agreement. So we can use this total return swap as an alternative to the repo markets as well. And a very useful feature is that we can customize these swaps to what our needs are as far as maturities. If we want exposure to a long type of investment, let's say a 30-year bond or a real estate investment, we don't have to keep that type of maturity on our books. We can enter a total return swap for, let's say, 6 months or 2 years or 5 years, whatever meets our investment goals, we can create with a total return swap. Even though that maturity might not be available in the market, we can create that ourselves. And then we have something called a funding cost arbitrage, which is best explained through an example. We have Great Bank with a cost of funds of LIBOR plus 5 basis points, and Good Bank with a cost of funds of LIBOR plus 25 basis points. Now, Great Bank has a risky loan on its books that it wants to lay off, and Good Bank wants exposure to that and at the same time lower its cost of funds. And both of them can get what they want if they go through the exchange of a total return swap. In this case, everyone wins. Great Bank gets to manage its credit profile for its portfolio the way that it wants, either selling risk or buying risk through the swap. And Good Bank gets exposure to a loan that it might not have had access to on its own, and at the same time simulates as if it had a lower cost of funds than it actually does, thereby getting the funding cost arbitrage. Now, there's some other terms to a total return swap that you should know about. The maturity is less than the underlying asset, except in the case of illiquid assets, which must have the same maturity. Now, for bonds, they amortize or accrete, which changes their principal value. So the swap has to be adjusted when these changes occur. There's no exchange of principal or the ownership of the asset. That's how we get our leverage. But there is an option to actually buy the asset at the maturity of the swap. And so the investor can actually have the investment. And as we noted, we can create our own maturities when they're not available in the market. Well, that's it for our total return swap video. If you have any questions, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.